5,300 employees. That's how many people Wells Fargo fired, for doing exactly what management had pressured them to do. And the damage? It didn't stop at the headlines. It cost shareholders over a decade of compounding. For 30 years, Warren Buffett called Wells Fargo one of his favorite investments. He bought his first shares in 1989. By the peak, Berkshire Hathaway owned nearly 500 million shares. And then, in 2022, he sold every last one. What changed? Not the products. Not the customers. The culture. And the third lesson from this story is the one most investors completely miss. For most of its history, Wells Fargo was the gold standard. Founded in 1852 during the California Gold Rush, it built a reputation on trust. Stagecoaches. Safe deposits. Main Street banking for ordinary Americans. By the early 2000s, it had become the most valuable bank in the world by market cap. Buffett loved it for a simple reason: it had the cheapest deposits in the industry. When your raw material costs almost nothing, and you can lend it out at 5 or 6%, you've got a beautiful business. In 2015, Wells Fargo was worth more than JP Morgan. Think about that. A regional California bank had outgrown the financial titan of New York. But underneath all that success, something had gone deeply wrong. Here's what most people don't know. The rot started in the 90s. A banker named Richard Kovacevich, who'd later run Wells Fargo, became obsessed with one metric: products per household. He called it going for GR8. The goal? 8 financial products per customer. Checking, savings, credit card, mortgage, auto loan, and so on. On paper, brilliant strategy. More products means stickier customers. Stickier customers means lower churn. Lower churn means higher lifetime value. But here's what happened in practice. Branch managers got quotas. Tellers got daily sales goals. Bankers who missed their numbers got written up. Then fired. Then blacklisted from finance entirely. So what do you think thousands of underpaid employees did when their livelihoods depended on hitting impossible targets? They cheated. Between roughly 2002 and 2016, Wells Fargo employees opened around 3.5 million unauthorized accounts. They forged signatures, created fake email addresses, moved customer money without permission to hit sales targets. The LA Times broke part of the story in 2013. The LA City Attorney sued in 2015. And on September 8, 2016, the regulators brought the hammer down. A $185 million fine. CEO John Stumpf gone within a month. But that was just the beginning. Here's where investors really paid the price. In February 2018, the Federal Reserve did something it had never done before. It imposed an asset cap on Wells Fargo, freezing the bank's total assets at roughly $1.95 trillion. Think about what that means. A bank's entire business model is to grow its balance sheet. Take in deposits. Make loans. Earn a spread. Repeat. The Fed basically said, you can't grow anymore. Not until we say so. That cap stayed in place for 7 years. It was finally lifted in June 2025. During those 7 years, JP Morgan grew its assets by roughly 40%. Bank of America grew by over 30%. Wells Fargo sat in a box. Total fines, settlements, and regulatory costs eventually exceeded $7 billion. But the real cost wasn't the fines. It was the growth that never happened. The loans never made. The compounding that was taken off the table. Buffett watched all of this. He'd invested because the business had an incredible moat, the lowest deposit costs in the industry. But a moat built on customer trust can drain overnight. And when Berkshire finally exited completely in 2022, it wasn't because the economics had changed. It was because the culture had. Here's the lesson most investing videos won't tell you. When you analyze a business, you look at the numbers. revenue, margins, return on equity, debt levels. But the single most important variable doesn't show up on any spreadsheet. It's culture. Peter Drucker said it decades ago. Culture eats strategy for breakfast. Wells Fargo had the strategy, the brand, the moat, the customer base. What it didn't have was a culture that valued doing right over hitting a number. And here's the mildly controversial take. Most investors, even professional ones, never really assess culture. It's too soft, too hard to quantify. So they ignore it, and then act shocked when companies like Wells Fargo, Boeing, or Enron implode. A real value investor, the kind Benjamin Graham trained Buffett to be, understands that quality of management and quality of culture are inseparable from intrinsic value. If the culture is rotten, the moat is an illusion. You're not buying a fortress. You're buying a house with termites behind the walls. Here's the principle. A great business with a broken culture is a mediocre investment with a beautiful disguise. Wells Fargo had every competitive advantage Buffett looks for. Cheap deposits, scale, brand trust built over 160 years. And it still lost nearly a decade of growth because of one thing: a culture that rewarded dishonesty over service. Price is what you pay. Value is what you get. But culture is what decides whether that value holds up or rots from the inside. This is educational content, not financial advice. Always do your own research. So here's my question for you. What's a company you've owned, where you think the culture is either exceptional or dangerously broken? Tell me in the comments. I read every one. And if this changed how you think about analyzing businesses, hit subscribe. Tomorrow, we're looking at market history and why 1987's Black Monday still matters today.